Shout out Sean, man.
Changing the game through real estate, yeah. Changing the game through real estate. I can never wait, got what it takes to got this on my plate. And I got a budget, teach you how to save. Listen to this podcast, you will be amazed. Play this any.
Yeah, so Tyler, great to be here, man. Thank you so much for having me on. So I grew up, my parents, they're one of the biggest days of the year was even though my dad made good money as an executive, one of the biggest days of the year, my mother would come to the door with this yellow envelope from the IRS saying, hey, it's tax refund day, and we might get a check for like $600. And of course, that was a cause to go out and shop and blow it and go out to nice restaurants. My parents didn't know a thing about investing. And when they passed away, God rest their souls, when they passed away, they didn't leave us anything except a little bit of credit card debt and a few $1,000s, in the bank. And, they were great people and they left a great legacy with me as far as all kinds of things, but money wasn't one of them. So I had an engineering degree, an MBA, went to Ohio State for that, then went on to Ford Motor Company. I left there in 5 years to start my own firm with a business partner. And we enjoyed a 5-year run where we made pretty good money, but we ended up selling to a publicly traded firm. And that was 25 years ago. And I found myself launched out of there in 1997 at 34 years old with, a lot of energy, a lot of excitement, but no knowledge of how to be an investor. I actually started a nonprofit organization to reach out to international students studying in the US who were lonely and didn't have family and friends and things like that. And I started investing in real estate to protect and grow my own wealth. And, whilst a lot of what I did was investing, a whole lot of it was speculating. Investing is when your principal is generally safe and you've got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. And I was more of a speculator than an investor, I think. And so 10 years from the time I sold my company, to the month, I looked at my bank account. I had $1.5 million in the bank after selling our company in 97. And 10 years later, I had $2.5 million in debt. That debt, thankfully, every bit of it was against real estate. So it was all connected. That was including my home, my lake house, and a whole bunch of waterfront lots and a few other properties. And so we found ourselves really with our back against the wall in the fall of 2007, not knowing that we were about to plunge into the greatest recession since the Great Depression, and had no way of knowing what was coming. Of course, I mean, we should have seen the signs on the wall, and if I would have read Howard Marks and Warren Buffett and all those guys at that time, I think I would have been way ahead of where I was. I'm sure of it. But at any rate, in January of 2008, we launched on this great adventure, and we basically decided to give our way out of debt as a family. And that didn't make a lot of sense to my CPA or her husband, who met with me to maybe do a sanity check with me. But we started giving a set amount every week. And our goal, we said, look, if we end up bankrupt, then that's the path we're on anyway. If not, hey, maybe God will rescue us from the mess we're in. And we'll see what happens. And because I had studied all these people, this law of giving and receiving, they call the Go Giver book and all that stuff. And now the Go Giver, I did not know about that book. I don't think it was around yet, but I knew the principles. And so we started giving, and 4 weeks later, I had this really, I guess you could say, chance encounter with a real estate developer at a Subway restaurant. And I said, man, I've got this big piece, this 5-acre waterfront lot that I really speculated on and I lost. And now I've got a massive amount of debt against it. If I could have only subdivided it, then we could get free of this. This was at Smith Mountain Lake in Virginia.
Yeah.
And the guy's like, well, here's an idea. And he gave me this idea. And I was like, yeah, that won't work. I know that law. I know that that won't work. And then I had this light bulb moment, like it was like dropped out of heaven, this idea for how to make it work. And so what happened is over the next 2 days, we drew up this with a surveyor, and the surveyor was like 70 years old, really embarrassed to go into the county planning and zoning office to propose this because it was outrageous what I wanted to do. But anyway, the lady at the county planning and zoning office, she studied what we said, and she looked over her glasses and she said, Mr. Moore, I've been in this office for 30 something years, and no one has ever come to us with such an outrageous way to circumvent our law. And then she smiled and she goes, but you did. And you're right. There's a loophole in the law and you found it. And yes, you can do what you want to do. And anyway, there was a lot of work left ahead, Tyler, and we spent months and months with surveyors and septic engineers and marketing people and banks especially, and all kinds of stuff had to happen. But we ended up being completely debt-free 13 months later. So that was my story. In fact, we even paid off our house.
Wow. So one thing you said that really touched me, you said that you're like just more or less giving your way to kind of pay off your debt. I feel like that's very interesting because a lot of people always say like, oh, once I make it, then I'll start giving, and I'll give. And you were like upside down, but you continue just to give because you believed in your heart that's what you should do. What really made you, like, inspired you to do that?
Yeah, I'll tell you who inspired me to do it. The guy whose name is George Mueller. Here's his picture on my iPhone. Now, you don't see many pictures from the 1800s where the guy's smiling, but this guy he was smiling because he was happy. This guy was a cheerful giver. Anyway, he made a decision as a young man to never, ever tell anybody what their needs were, and to never do any marketing, to never do a fundraiser. Yet he raised something like $250 to possibly even $500 million in today's dollars to build orphanages in Bristol, England. And they ultimately housed about 10,000 orphans. But he basically, his attitude was like, look, you can't possibly outgive God. And if I trust God, God will bring exactly what I need when I need it to the day. And he's got, I don't know how many thousands and thousands and thousands of pages of journals where he documented every single step along the way, every dollar they received. And it's just an amazing story. So it was his inspiration that caused that crazy move that we made.
Oh, wow. I think that's really interesting because that's kind of how I try to relate like my daily life. Because like, so when you mentioned Christ came back, he was more or less giving and also a servant. And I feel like that's like one of the key principles in business is just serving others. And I feel like a lot of people have the misconception. It's kind of like, oh, it's in for me. How much money do I make? But rather than the opposite effect, it's like, hey, how do I help someone else? How do I solve their problems? How do I help other people? Do you kind of agree with that philosophy?
Yeah, I totally agree. It's, and there's tons of data out there that prove it now. Jesus didn't say it's a good idea to give. He said it's more blessed to give than receive. And when he said that, we're talking about the creator of the universe. He basically said that this is how it is. He could have just said, hey, gravity works and things fall to the ground. I know that it's technically different than that, but you get the point. He could have said that, it would have equal weight to what he said. It's more blessed to give than receive. That is that's the fabric of the universe. It's a law, just like gravity.
Yeah, that was one of the main things I realized from like me being as a real estate agent is I realized that for me, buying a house is very like transactional. I don't get emotional, but like helping someone else, like them and their family and seeing the joy through them, I feel like there's so much joy and kind of very fulfilling that I feel like that's the true like way to receive happiness is just to give and to serve. But just kind of like talking about, you got into investing, you split it up, you went into multifamily syndications after that, right?
Yeah, so over the years, Tyler, I was trying to figure out how to get into commercial real estate. I wasn't sure how. I wasn't sure where the on-ramp was, who to trust, how much money I would need. And we ended up, that same business partner and I got back together in 2010 to speculate in oil and gas in North Dakota. And when we did that, we also realized there was a massive housing shortage for oil workers in North Dakota. And there was an oil boom there called the Bakken. And so we actually quickly built a multifamily / hotel and housed oil workers and executives traveling to North Dakota. And we did a couple of those and it worked out really, really well. And he ended up building a Hyatt hotel after that. And I ended up going into multifamily. I wrote a book called The Perfect Investment. But I found out the perfect investment, which is about apartments, buying and selling large apartments, the perfect investment wasn't perfect if you can't find deals that make financial sense and that don't have enough margin of safety built into them for the coming economic shock, because there's always an economic shock going to happen at some point. And so I really scratched my head and I had a really hard time with this over many, many years. Because again, I'd written this book and again, we had built our whole company around syndicating apartments.
Yeah. So after you just got above water, you're like, oh, let me just go jump back into it again. What made you like, oh, okay, we barely survived this aspect. What made you want to like, okay, jump into it more, try something a whole different aspect? What made you like take that leap, even though you barely survived over here?
Yeah, so I saw it as a way, instead of transactionally, because as a real estate agent with a brokerage and everything at Smith Mountain Lake, I was getting a lot of transactional income, but I wasn't building true wealth. True wealth is having assets that produce cash flow. And without having assets that produce cash flow, basically I have to work until I die. Right?
Yeah.
Because Warren Buffett said, if you don't learn to make money while you sleep, you'll have to work until you die. And that was the situation I was in. And I wanted to build assets. I wanted to grow a company with assets that produce cash flow. That's why I got into multifamily.
So you wrote the book, The Perfect Investment. And one of my partners believes in large scale apartment buildings is the safest, best investment. So I know that you wrote that book and you believed at that time. What changed your mind from like, okay, from maybe that's not the safest investment to what you do now? Like what happened? Why was it the safest investment then? And why is it not the safest investment now?
Yeah, so Buffett says he will only invest in stuff that has a significant margin of safety. Howard Marks, who wrote Mastering the Market Cycle, writes that the most risky time to invest in an asset is near the top, when it's hitting record levels. And one of the reasons it's so risky is the obvious, but it could go down in value. But the worst reason is your margin of safety is so low. In other words, another way to say it is everything has to go right to make this investment work. And if everything doesn't go right, then it could collapse. I mean, if interest rates, let's say I'm getting floating rate debt and interest rates go up a point or two, and cap rates expand a point or two, and inflation doesn't go up by 8 or 9 or 10% this year like they predicted. If everything doesn't go right, if you have to do if that has to be the case, then I think you're speculating. And I was starting to see multifamily investing, for me at least, as a speculation. And the crazy thing, Tyler, is you don't really know who good investors are and who speculators always are. You don't always know until the tide goes out. The rising tide has lifted all boats the last 13 years since the Great Recession. But Warren Buffett says the tide will eventually go out and then we'll see who's skinny dipping. Well, I don't want to invest with skinny dippers. I assume you don't either. I assume your audience doesn't either. But that's what it started to feel like. And that's why I was, after pulling my hair out for years, we finally made a big switch a number of years ago.
So what margin of safety are you looking for though? For like, let's say for specific investment like multifamily, what margin of safety were you looking for?
Well, I mean, if you want to measure it with my favorite measurement, that would be the debt service coverage ratio. Other people call it the debt cover or the debt coverage ratio. And
Yeah.
that's the ratio of net operating income to the debt payment or the debt service. And the banks want to see at least 1.2 or a 20% margin of safety. And I used
Yeah.
to think, oh, that's kind of high. And now that's laughable to me. I really want to see a debt service coverage ratio, going in, if possible, at double that margin of safety. That would be a 1.4 or a
Okay.
40% margin of safety. And I like to invest in assets that have intrinsic value that is so deeply embedded that we can raise that. We work with operators that can raise that margin of safety or that debt service coverage ratio up to well above 2.0 quickly.
Mhm.
And so I can give you an example if you want, but the bottom line is we like to see a much higher debt service coverage ratio and a much lower than the max LTV, which loan to value ratio, and those go in hand in hand.
You mentioned intrinsic value. Warren Buffett talks about that all the time, but I feel like a lot of people don't really know what that is. Can you kind of explain what intrinsic value is?
Yeah, the greatest sculptor, the most famous sculptor, at least of all time, Michelangelo, said, when I look at a block of granite, I don't see just granite, I see an angel trapped inside. He said, all I have to do is knock off all the extra material around her and then I'll set her free.
Yeah.
And that's similar to intrinsic value. Basically, Michelangelo didn't see $100 in today's dollars block of marble. He saw a $1 million sculpture inside. And that's what great operators do. A great real estate investor can often recognize an asset class and often a mom and pop owned business, whether it's an apartment, a single family house, a self-storage facility, a mobile home park, an RV park, a light industrial facility. They can see intrinsic value baked in that other people couldn't see. My team just got back today from touring a large self-storage facility, and the guy was showing us, the operator, this is actually a really well-run one, not a mom and pop one. And he was showing us how they used, almost every square foot of the building, the parking lot, etc. When he bought it, and I actually don't know what he paid. I really don't. But let's say he paid for $1 million empty shell, which was an old warehouse that was kind of just not looking like a great piece of property. But now he put $6 million into it, and he's created what I believe is about a $15 million value facility because he was able to look inside and see intrinsic value. If you want, I can do a quick list of specific examples of what that intrinsic value might look like.
Sure.
So for a single family house like my friend Eric Eichhoff sells in Minneapolis, it might be a house near campus that's valued at $400,000 on the residential market, but his investors can divide it up into, let's say, including the basement and everything else, 7 sleeping rooms. It could be 4 bedrooms plus a basement, but they might be able to divide it up into 5 or 6 rooms that house 8 or 9 students, and they charge by the bed. That is potential intrinsic value. Now, if you look at the value of that house now, at least the way it functions, it's operating at, as if it's worth almost $1 million, not 400,000, which would be the value if you rented it to one family or whatever. Intrinsic value in self-storage might look like being in the right location and leasing U-Hauls out of the front of your building. You could be a self-storage facility leasing out U-Haul and get a $5,000 a month commission from U-Haul. I know of a guy doing $13,000 a month in commission from U-Haul right down at the road here in Christiansburg, Virginia. Well, 5,000, let's just look at 3,000 a month in commission. 3,000 a month in commission. You set up a contract with U-Haul, you get a new computer to operate that. There's no other capital expenses except making sure you have a place to park the trucks out front of your self-storage facility. Or it could be another type of business, but that's the best that I know of. So $3,000 a month in commission income is $36,000 a year. $36,000 a year in commission income at a 6% cap rate. That's the rate of return that a commercial real estate investor would expect on an unleveraged property. In other words, 6% would be, what I expect as my cash flow per year. At a 6% cap rate, that $36,000 in annual income turns into $600,000 in value. So if I bought a self-storage facility for $2 million and I signed a contract with U-Haul and started making $3,000 a month, and that was sustainable, my value of my facility just went up from 2 million to 2.6 million. That's one change. Here's another change. We just got word that our largest operating partner bought a self-storage facility this week in Punta Gorda, Florida. He's going to be able to raise rents 24% in 60 days. And this guy's got decades of experience, and their team's got like 200 years of experience doing this. They know what they're talking about. If they raise the rents 24% because they're so far under market, that's going to, it's going to, first of all, generate hundreds of thousands of additional income for this large facility. But more importantly, it's going to raise the value of the equity by almost, I think it's 80%. Here's the math on that. If it's 24% increased revenue, that's about 35% increase in net operating income. Now, if the leverage is 66%, you can multiply that 35% by 3 to get to the actual increase in the value of the equity. And I know I'm throwing a lot out here really quick, and we can circle back to this math. But anyway, actually, I was wrong. That's about 100% increase in the value of the equity. So, I mean, it's just, imagine doing that, providing that kind of intrinsic value extraction in just 60 days. That's why I got out of multifamily and, basically expanded into these other asset classes.
I think the biggest setback for people trying to get in self-storage is they don't really know how to go about getting into it. So how would someone that, let's say they're been in multifamily and they're trying to get into self-storage to really learn? I know you're coming out with a new book, and we could talk about that. But how do you go about getting into self-storage and learning as much as you possibly can about it?
Yeah, so I was frustrated for years trying to figure out how to get involved in commercial real estate other than becoming a commercial broker. And so when I wrote my book called Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage, I actually spent the last 1/3 of the book answering that question. How do you get involved in any type of commercial real estate? And in this book, specifically self-storage, there are 7 paths to getting involved in any commercial real estate, and specifically self-storage. Should I go over those real quick?
Oh yeah, let's go ahead.
Great. So the first path would be stair stepping. Stair stepping would be you buy a really small facility like my friend just bought in Roanoke, Virginia. You fix it up, clean it up, you improve the marketing, you improve the rents, you improve the occupancy, you maximize it, and then you sell it and you buy a larger facility. Then you just rinse and repeat over and over. Now you could refinance and go out and buy a larger facility as well. So that's stair stepping. A second path would be being a capital raiser. Being a capital raiser looks like raising, let's say you have a lot of contacts, or you're really good in, internet marketing or other marketing, or you're really good in sales and you want to raise capital. Well, you partner with somebody who's a great operator and you raise capital for them. It might look like being an employee at first and then a partner later. It might look like you join a mastermind and then you and several other people come together to form a company. What you shouldn't do is expect to get paid commission on raising money, because the SEC frowns on that horribly. Path 3 would be being a deal finder, and it looks a lot like being a realtor, but you're out there beating the bushes, finding the very, very best deals you can. It might look like driving all around the whole Chesapeake region, for example, and stopping at every self-storage facility. It might look like, sending handwritten letters or cards or phone calls. My friend has 8 people plus a manager doing full-time phone calls, texts, and emails to owners of self-storage and mobile home parks to try to see who wants to sell. So that's a third path, being a deal finder and then staying involved in the deal with the operator. A fourth path would be go big. Go big is for those who made millions of dollars in Bitcoin before it dropped, or
Doge
or
and all
won the
that stuff.
lottery. Yeah, right. Or won the lottery, or they inherited a lot of money, or they, retired from the NFL. Going big is not a path for very many people, but you can just jump in at a big level and hire the right talent. Let's see, was that the fourth path? The fifth path is get a job. Now, a lot of people listening to this show are trying to get out of a job, but getting a job can be a good idea, because you can, if you get a job as a manager, let's say, of a self-storage facility or a mobile home park, by being a manager, you learn the lingo, you learn how to run it, you learn everything you need to know, you get to know the right people, and you might find your future business partner and be able to start your own firm or buy your own facility. You could also be, in addition to a manager, you could be an asset manager, I already mentioned a property manager, a broker, a lender, a financial analyst for a self-storage company, and there's lots of different paths to W-2, to W-2 or K-1 income in the self-storage arena, or 1099 income, I should have said. The fifth path is get a job. The sixth path is find a coach or mentor. Now, you can find a mentor out there, like somebody in your town who's really good at it, and you just learn from them. And I know some folks in your area, in fact, in the Chesapeake area, where my friend went to them and said, hey, I just want to learn from you. And they actually gave him a role, and they're helping mentor him in learning to buy apartments. Or you can do a paid coach. Right up the other way from you would be in Richmond, Virginia. My paid coach was in Richmond. I paid him $25,000 to teach me all the nuts and bolts of multifamily many, many years ago. And then I had the opportunity to partner with them on deals if I wanted to, or partner with other people in my mentoring program or my paid coaching program. So that's path 6. Path number 7 is be a passive investor. If you've got cash, but you've also got a demanding job, or or retirement, or you value your time with your family, you don't want to be spending it in the evenings, working on your real estate business on the side, being a passive investor can be a great option, and it can lead to relationships and knowledge that'll allow you to be an active investor when the time's right.
So what about I know for people are raising money, you have to be an accredited investor. Like, what happens about the people that don't meet that guideline, but they still want to invest in the passive into real estate? Like, how does that work?
Yeah, there's very few great options that I know of for non-accredited investors. The SEC, in order to protect the American public, about 80 or 90 years ago, set up regulations and said you have to be an accredited investor, which means you basically have to be a millionaire or have high income to invest in most of these deals. There are other options. There's a thing, Reg D 506C is the typical way most people go to market with these syndicated deals, but there's also 506B, which allows 35 non-accredited investors. There are other options that don't include accredited investors, but they're
like
pretty
Reg
hard to
A
find.
and all those.
Yeah, Reg A would be another one, right?
Yeah. So I know a lot of people, I have these conversations all the time, that are very hesitant to get in the market right now because they think a housing crash is coming. What's your because you've been through the ups and downs of the 08 crash, and you kind of got hit before and then got hit even harder in the 08 crash. Do you think we're going to a housing crash? Like, what's your opinion on the market and everything happening?
Yeah, I just met with a guy who ran HUD. He was the commissioner of HUD, and years ago, like about 12 years ago. And he said that the current Fed chief, Jerome Powell, is 100% disciple of Paul Volcker.
Oh yeah, I heard that too.
Yeah, Paul Volcker is a guy who in the 1980 range or so under Reagan said he was going to eradicate inflation at any cost. And the cost was raising interest rates as far as it took to eradicate inflation. Of course, they didn't have the national debt and the magnitude of national debt that America has now. But excuse me, he raised interest rates into the teens to eradicate inflation. Jerome Powell's not going to have to, go into the teens, I don't think, but he's going to. The Fed will raise interest rates, according to my friend, at least 2 more times this summer and more next year. And the result will be, according to my friend, a deep recession for sure. That's what he says. And so the question you asked is it a good time to invest in real estate? Well, no, it's not a good time if you're over leveraged and you're paying top dollar for stuff that has no intrinsic value. But if you're safely leveraging with, moderate fixed rate debt, and you're able to get assets that have a lot of intrinsic value built in, then yeah, I think it's a great time to invest in real estate. And it might even get better if the economy takes a big nosedive, which I expect, could very well happen.
I know a lot of people are saying they think it's going to be like the end of this year and so on. But I know by I guess the book, they said 2 consecutive downturns is technically a recession. If we start going into recession, I know interest rates always typically drop during recessions. Do you think that they will change their mind? And if we start going into
absolutely. Yeah. So the playbook goes something like this. We're going to raise interest rates until we cause a recession. And once they cause a recession, they usually overreact. In other words, they raise it one more time, the interest rate, just to be absolutely sure. And once they cause a recession, then curbed inflation follows. And once that happens, they start quickly lowering interest rates again. The typical cycle of raising rates is no more than 2 to 2.5 years.
Interesting. So with rates going higher, so when y'all do your self-storage deals, let's say you get a 4% at a 5 or 10-year term, are you calculating at the end of that 5-year 10-year term that massive interest rate increase?
Yeah, I mean, so we typically are investing for a 10-year time horizon. Our largest operating partner that we invest with right now at Wellings Capital has 7.1 years left on their term of debt, and it's an average of 4.1% interest rate. And so it's very, very likely that having us having a 10-year hold will give us a chance to ride down through a recession, back up the other side, and then have inflation, whatever inflation is, whether it's 10%, 20%, or 1%, whatever inflation we get along the way will likely stay with us, meaning that whatever rent increase we got during the downturn and the later upturn, that will remain. And so it's likely, again, a 10-year hold. Buffett said my ideal holding time is forever. And we don't want to say forever, but we really do like a long-term hold.
Yeah. I've heard people saying that they want to hold it forever, but have multiple exit strategies just in case. So, for instance, they always have the talk about self-storage being recession resistant. Do you kind of also agree with that, with self-storage being recession resistant? Because no one likes to get rid of their stuff. So
yeah, it's definitely not recession proof, but it's recession resistant in America because people, for a very small amount of money, they can keep their stuff in storage. They might have to downsize from a $4,000 mortgage payment to a $2,000 rental unit, or even from a $1,500 rental to an $800 mobile home. But they want to keep their stuff, and they can typically keep their stuff for about $100 a month. And so it's kind of a small part of their overall picture. Another funny thing about that is, look, if I raise your apartment rent by 10% and you're renting for $2,000 a month, well, you might move rather than spend that extra, what would it be, $200 a month, $2,400 a year on rent. But if I raise your storage unit that you're renting for $100 by 10%, you're probably not going to spend a weekend, get a U-Haul, get your friends together to move your treasures down the street just to save $10 a month, especially since it's on a month-to-month lease and you can leave anytime. So yes, self-storage bounced back quickly after the 2008 downturn. COVID actually saw an increase in traffic and revenues and profits due to the fact that there were bars and restaurants going out of business. There were college students with uncertainty leaving their stuff in storage. There were people moving across the country, a lot of them coming out of big cities, going into rural areas. There were offices who were shuttering a lot of office space because people worked from home for a long, indefinitely. And so all those things help self-storage go through the roof. The facility I toured today in my little town of Lynchburg, Virginia, had 99.6% occupancy. And they said that they pretty much stay in that range all the time.
I have an interesting question. So I remember I was talking to during the peak of the pandemic, people were saying that they were like working out through their storage unit. They had storage unit, they had the gym equipment in there working out. And I heard people were sleeping in there too. Like, do y'all have like ways to like prevent that? Because I can feel that could be a massive liability issue.
Yeah, just great security, housing camera, cameras. I don't know why I said housing, but cameras that they can, watch 24/7 if they need to. Someone's going to have to park a car somewhere to get in there, or if they're going to have to walk. And that's just not okay. And that is definitely a violation of the contract with the individuals.
So I've listened to your episodes on Bigger Pockets and my friend Bridger Pennington's show. You mentioned entrepreneurs need to have like a why, like a purpose, and why they do everything. What's your why, and why do you believe like they need like a higher purpose? So like, what's their big why like that? Why is that important to you?
Yeah, when I sold my company in 1997, I woke up the next morning maybe a little happier, but overall, it's not like it completely changed my life. And I actually was kind of bored. And so I kind of went chasing some things for a while and didn't know what to do next. I think we were created for a purpose, and I think it's really important to have a big why that transcends money or our business success. And I think the big whys, should be based on relationships of some kind. Now, I want to go over a couple statistics that might shock you and your audience, but if you took the record profits, not the average, the record profits of Apple, General Motors, Nike, and Starbucks, added those together, doubled that number, you'd come up with the approximate annual profits of generated by human trafficking, according to the US State Department. And so that's a huge number. Now, I'd like to believe if I lived in the 1800s, I would be an abolitionist fighting for freedom for slaves. Or if I was an adult in the 1960s, I would have been fighting for civil rights. Well, this is a civil right. This is slavery, and there's more slaves on the earth right now than any time in human history. And so my company, Wellings Capital, is doing what we can to try to get the word out about this, to fight human trafficking, and to rescue its victims. Our goal is to give 5% of our profits this year and more in the future. As individuals, we're giving on top of that, sometimes more than that. And we're actually encouraging people. For example, I'm going to a mastermind next month in Florida, and our goal is to try to raise over $200,000 from other participants at that mastermind if we can.
Oh, wow. So speaking of that point, I actually went to a conference probably in July, and I heard this guy speak. His name is Tim. He runs United Underground Railroad in Utah. And he does that same kind of thing. Like they're ex-special forces. They go and try to like give the cops to like everyone the proper equipment to actually find all these people. And one of the things that we mentioned earlier that I want to say, because when I listened to him speak, he said that when like over there in Ukraine and Russia and everything like that, like you talking about like profits from like selling kids. He said when the Russians like attacked and started bombing, all when a lot of the parents died and a lot of the kids had nowhere to go. Well, the sex traffickers actually put up a billboard that says orphanage, and then all the families and parents didn't realize, they just said, like, saw these kids, they couldn't take care of them, so they would take them to the orphanage, and it was actually giving the kids to the actual sex traffickers just to get put back in the system. And yeah, you're absolutely right. There's definitely a very big need, and I feel like it's not really talked about very much now. I'm not sure why.
It's really incredible. Yeah, I didn't even heard of it till like 6 years ago. Then I got involved with, I saw a movie called Nefarious from Exodus Cry, and I highly recommend that movie. I got a bunch of copies of it. I'll send it to people who want it. Our investors know that we're really passionate about this. It's actually better to just tell you that you can get it online on YouTube, I think free, or you can rent it for like $3 online.
So when you said your company tries to help fight sex trafficking, what do y'all do? Like, do y'all donate to like other charities that are doing those specific works? Like, how do y'all
Yeah, we do. So our company, we haven't really talked about this. Our company vets the very best of the best commercial operators we can find to try to find the best places to invest our investors' cash. And so investors give us money, and we spread it out over a diversification of different asset classes, geographies, operators, strategies, and deals. And so our main thing we do is due diligence. Well, we decided, why don't we take that same due diligence tactic and apply that to the sex trafficking problem. And so, like, when I hear the statistics, like that story you told, or the statistics I mentioned, I'm not sure what to do. Do I go join a raid? Do I, send money to somebody I really don't know and trust? Well, Wellings Capital, what we're doing is we're doing due diligence on organizations to find the very best of the best, most effective operators, and then we're donating 5% of our profits to them. We're also encouraging our investors to donate to them. And we're also doing these events like the mastermind I told you about in Florida. And we're doing podcasts like these to raise awareness.
Yeah, because I know that the United Underground Railroad, and I could put the link below, but other than that, I don't really know of that many organizations that do that. So how do you go about finding those organizations, and what's some of the organizations that y'all work with and that y'all donate to?
Right now, we really like Exodus Cry, and I personally donate to them. I've been out to visit them a couple times at their headquarters, but in addition to Exodus Cry, our company is officially donating to one organization. It's called AIM, AIM, and the website is aimfree.org. And I highly recommend that people go there. We're also, I forgot to mention, trying to create matching grants to get donations to AIM.
Oh, wow. Yeah, because I mean, like that, like you said, that money is great and all, but it's like it's so, like, if your goal is just be a millionaire, okay, once you get it, then what? Well, you be a billionaire, then what? I feel like a lot of like the true joy is finding something that's a purpose that's bigger than yourselves, like helping charities just like that are going about doing things that you may not have the skills or the knowledge or the power to do, just like help empowering people and maybe just doing your part in helping stuff. Do you just want is there any other points of your book that you want to point out, storing up profits?
Yeah, I mean, there are 53,000 or so self-storage facilities in the US, and about half of them are run by mom and pop operators, which means that they could be run really well, but often they don't have the desire or the knowledge or the resources to upgrade the facility, increase income, and maximize investor return. And this is one of the reasons we love self-storage. And mobile home parks are quite similar. About 85% or so of the owners are mom and pops, and there's just a lot of upside by acquiring the right facility, treating the tenants well, and upgrading for everybody's benefit and the investors and profit.
I think you mentioned it in one of your past episodes. You said, I think it was 93% of all multifamily apartment buildings are owned by large hedge funds, and they've pretty much like maximized all their value and everything like that.
Yeah.
Was that what it was? I could be
Yeah,
way off.
93% of multifamily assets above 50 units are reportedly owned by companies that have multiple assets. And generally, as you and I both know, at this point in the cycle, they've already done the value adds. They've already bled off as most of the intrinsic value out of those assets. That's why I love these asset types like RV parks or mobile home parks, where a huge percentage of the owners are mom and pops who have not maximized value.
So RV parks, mobile home parks, self-storage, those are the three main asset classes that you're really looking at right now.
Those are three that we really love.
Okay. Yeah. Because
We
they're
also do light industrial and others.
yeah, because I heard industrial is actually very hot right now also with the
It
e-commerce.
really is. You know that 53% of industrial is light bay industrial, but only 3% of new money that's coming into the space is going toward light industrial. A lot of it's going towards warehousing and Amazon type facilities and such. And so light industrial parks or, you know, office parks, industrial parks, etc. There's a lot of potential upside because a lot of them are owned by mom and pops. In fact, we believe that I think 97% of the ownership is non-institutional in these small bay office parks or industrial parks.
Oh, wow. So do you have any last piece of advice for anyone just wanting to get started, like they're scared to get started? Do you have any last minute advice just to help encourage them? And
yeah, you know, really, you know, I mean, you've heard it said that the best time to invest is when blood's running in the streets. And so, you know, store up all the capital you can now if you believe there's going to be a downturn, and prepare to buy when everybody says you're crazy, including your own friends and family. That's the time to buy. When everybody thinks the market couldn't get, is never going to stop growing and, you know, blowing up, that's the time to run away. When everybody thinks the market couldn't get any worse and it was just going to continue to get worse forever, that's the time to buy.